Hello, everybody. Welcome to my talk. We're here again with another chapter. I actually read two chapters, chapter 7 and chapter 8, because they were not as interesting as chapter 6. And they don't have a lot of information that I thought was very well. It is important information, but I didn't understand a lot of it. So I'm going to give you the summary of what I understood from both. And on the last chapter 8 was, I'm just gonna read you the last page because that encompasses like the whole chapter 8. But for chapter 7, Treasury builds the ultimate safe haven. So this chapter talked about how in other years and past years where where we have depressions or we're down in a slump, the T-bills are always safe. Like I'll read a couple things, but like in 1989, for example, while long-term T-bonds and stocks were giving investors losses of 5.1%, that is what I don't get. When, like the percentages, I don't know. When I'm reading it, I don't understand what I'm talking about in percentages, and it has a lot of this throughout this chapter. So losses of 5.1% and 8.5% respectively. 1 year, T-bills returned 7.5%, well above the 6.11% CPI increase of that year. So everything was down and everybody was losing money, and whoever had the T-bills, short-term T-bills, were gaining money. So at any time that this happens, the T-bills are giving you money. And like right now, maybe stocks are high and everything, so T-bills are not going to be that good, but they're always giving you a little bit of money back, and a little bit of money is better than no money or losing money. So that's the whole thing about the safe haven for this one. So early in 1973, while stock had negative returns of minus 14.66%, and bonds cost their holders 1.1% before the inflation rate of 8.80% was figured in 1 year, T-bills gave their owners a 6.76% profit before inflation. Because from the other chapters, inflation is the one that drives the gains and T-bills down, because then their interest has to go up, something like that. Therefore, you wouldn't get as much. But even though when it's low, you want to go for T-bills. Here it goes with that. The bad news about them, which I exposed briefly in chapter 3, is that there is one basic enemy of T-bills that can cause you to virtually lose money, even in the safety first, last, and always fixed income securities. The enemy is called the rate of inflation, which can drive up general interest rates, thereby forcing the value of T-bills down. So inflation. So we have to be vigilant of inflation on T-bills and on everything, actually. And then, as I pointed out in chapter 3, T-bills are the shortest term obligation issued by the U.S. government, with the 3-month or 90 days T-bills the most popular maturity amongst the majority of savers. So when you do T-bills, it says it's not somebody that's trying to invest to make money, it's somebody that wants to save their money. and then you know the interest or whatever gains you get are just a little bit of here you go, nice little tip for you for being a saver, right? So it's not a huge gains, but it's always giving you a little bit of money. And then it talked about macro versus micro. And here's a little tidbit of that about that. While T-bills, when held to maturity, have historically provided slightly positive returns even after inflation, over time they've averaged about 3.7% before inflation. Taking a macro view of the last 72 years as an example, the annual rate of inflation in this country, as measured by growth in CPI, has averaged around 3.1%. That means T-bills have actually earned savers a little over 0.5% in real inflation adjusted interest during that period of time. So then they have tables here. And so the gist of this chapter 7 is just like all the ways and all the reasons why the T-bills is the best way to go at any times if you're not willing to risk, right? So points to remember, I'm just going to read them out really quick. If your primary concern is the safe guardianship of your investment dollars, there is no more reliable security than the short-term U.S. Treasury bill, the most liquid investment in the world. However, it is possible to get caught in a long period of time when, for whatever reason, interest rates go up and T-bills fail to keep even with inflation. The reason typically is people's misperception about the outlook of inflation combined with the U.S. government's misguided bias towards inflationary policies as occurred between 1932 and 1950. In such case, negative real returns after tax can be substantial. Therefore, it is possible to lose money, especially in inflation-adjusted terms, even in those ultimate safe haven called T-bills. So, you can lose money with these, but not very often. It is vital for every investor, experienced or inexperienced, to recognize the fact that there are certain times within market cycles when there are no attractive place to make money. The best one can hope for is to hang on to what one has, like those bank-fearing folks of the 1930s. Under such circumstances, T-bills are an ideal depository because one doesn't put money in them expecting to see a high return on one's principal. The objective is the safe return of one's principal until market conditions improve. Everything else is gravy. When market conditions and the economy are good and valuation levels are not off the charts, it is far more preferable to be in other types of investments that are riskier but will also provide a higher reward for the degree of risk you're taking. The key is to know when it's in your interest to take the risk and when discretion is the better part of valor. Sometimes there aren't any profitable opportunities for investment, and the wisest course is to just sit on the sideline for a while and low risk, normally returning T-bills. Especially in bear market, which as we've seen have come along quite frequently over the past 72 years, T-bills can be the perfect place to hibernate and get paid relatively handsomely while catching your Z's. So that was chapter 7, and then chapter 8 you should get paid for taking risks. And like I read right now, it's better when the economy is good to risk a little. If you're wanting big profits, then you want to risk and go to stocks or company bonds, which give you a higher buck for your risk. And it talks about, that the A-rated, of course, you want to go with A-rated companies because they won't fail. They might give you a smaller amount of money, but they won't fail because they're up high already. But if you want to make money, then you want to risk and go invest in CCC companies, which are lower, but because you're risking on them and they know you're risking, they give you a bigger return on your investment because they want you to help them out, so they're going to give you more. So that's pretty much what chapter 8 is about, just that if you are willing to risk it, that you should be compensated for it. And it brings many like examples of that, how it's a good profit to risk, but if you could also lose your money really, really quickly if you choose to be risky. So I'm just going to read you the last page of this chapter 8. So it's a judgment call, because they say when chapter 8, as a seasoned investor who has personally weathered many major up and down market storms, individual investment cycles, and manias, and studied many more, I have come to believe very strongly that every investor should be paid for taking risks. Oh, that's not what I wanted to read. I wanted to read the part where it says that in today's market, because it says that it's that the market is very based on the psychology of the investor and the government, policies. So whatever, like, the investors, one of them decides, oh my God, it's gonna be bad, and then everybody follows. So that's when everything goes up and down. So let me read you the last page. Maybe this is where I saw it. But it's important for investors to be aware of how different investments have been valued over time, what median returns have been, what these different investment vehicles are yielding now, and how to be sufficiently well compensated for the risk of loss by having a return that is accessible and advanced. No one knows for sure, of course, exactly what the future has in store for us. No one knows what the inflation rate's really going to be next year or the next. No one knows what corporate profits are going to be, but it is possible to look at current market conditions and, by comparing our three investment choices to each other in light of those conditions, make a calculated judgment as to which vehicle presents the greatest opportunity for achieving the high risk adjusted returns for the degree of risk one is willing to assume, period. So now that you are convinced, I hope that you should be paid for taking risks, the time has come to assess quantifying the amount you should be getting paid for the risk, and find out how to make the call that will lead you to be rewarded with above average returns. And that was the end. So I am done with part 2 of the book. So next week we're starting part 3, knowing where to invest. This is the part that I want to read, because I want to know where to invest. Because for the T-bills, you don't have to save $1,000. So it's something that I could work on now. So that I'm looking forward to part 3, which is the end, and then we have to find a new book. So I'm not sure. I think I want to go with Tony Robbins, more motivational because I really like motivation. That's what got me to reading and doing things that I am now crazily doing, like this, for example. But I think that is really cool. But, and I think in these two books that I read, I think I should be able to uh, work something out and see how it goes. So then we could talk about that. Because, like, I invested in my Beachbody business company. I bought a couple, 12 shares to be exact. And, I checked this month because I decided I'm going to check every month. I should probably be checking once a week, but I don't have time or make time or know how to figure this out yet. So I bought them at $12, and when I looked, they were selling at 9. So 9, 10, 11, 12. That was a $3 deficit. So I am not making money on my stock. I just lost $3 on each share. So that's where I'm at. But it's exciting and fun anyway. Hopefully we'll learn more on chapter 3 on knowing where to invest, because this was just something I wanted to do because I knew my company was going to do this. But maybe this will bring us some information where we could invest in something more profitable, and see how it goes. So I'll let you guys know what I'm doing with that, and we'll have a couple more chapters to learn about this investing thing, and I will talk to you next week. So if you want to hear what's going on, subscribe, listen to me every Thursday talking about investing, bond stocks, and the problems that come with them. Adios, amigos.